Hey YouTube, what is up? Welcome traders, hope everyone is doing amazing. And in today's video, what I'm gonna be talking about is options selection, right, for day traders. Option selection for day traders is something that a lot of people might misunderstand and oftentimes choose an option that is slightly worse than it could be and watch that their position goes in the right direction, but the option actually doesn't gain value. So I want to ask you this before we start this. How many times have you guys gone through an options trade, a day trade for example, scrolled through the chain and looked at, okay, which option is the most cheapest that I could afford and I could afford a lot of? Right? And then just click that one, select that one, and then you're on your way, right? Only to see that option doesn't necessarily gain too much value as the position runs your way. So you might be selecting something that's way too far just because of how cheap it is. So there are specific different rules that I like to go by when selecting options to day trade. I'm gonna break those down for you guys. What options are better than others, what strikes, so on and so forth. So if you guys are excited for this video, I want you guys to smash that like button, hit that subscribe button, and ring that little bell to notify you when we do go live and drop videos like these every weekend. So why don't we just get started with this and talk about what is a strike first and foremost. A strike on an option, very, very simply put, is the expected price by the expiration of the option. So you have calls and you have puts, right? If you have SPY right now, let's say it's trading at 410, and you buy some calls for next week that have a strike price of 415, your expectation is that the SPY, right, on those calls closes above 415 by that expiration, right? Same example, if you have 410 on the SPY and you're selecting a downside move, right? You're expecting a downside move, you're gonna be buying put options. Maybe your expectation is 405 in a few weeks, and that is the strike you're gonna buy. So the strike is the expected general move of the underlying, right, by a certain point in time. So you can select a multitude of different strikes, right? You can select strikes that are above the current price, below the current price, or at the current price, and each one of these is gonna be priced differently, and each one of these is gonna move differently. So easily enough, we transition into part two here. We're talking about out the money, at the money, and in the money. So right here on the screen, you guys can see we do have an options chain on Amazon, right? We talked about the strike price first and foremost. So we talked about the strike price, right? And you can see there's multiple different strikes. Now, those different strikes are around one main strike area. This one's gonna be at the middle. This is what we call at the money, right? Right in the middle where the current price is usually sitting, right? Both for puts and calls. So right at the money, you're gonna be trading a strike that's very close to the underlying in that sense, right? So if the underlying is 121.50, right, at the money is going to be 121.50. So we also have in the money here on the call side, right? These guys are going to be in the money. These guys are going to be in the money here on the put side. If they're in the money on the call side, they're going to be below the current price, right? They're going to be trading below that current price. So if they're on the put side, they're going to be above the current price. Then you have out the money, which sits down here in the dark, right, out the money, and then out the money here on the put side. And these on the call side are going to be above the current price. So people usually gravitate towards out the money calls. And what they do with those is that they pretty much find the cheaper ones, right? They're looking for cheap out the money calls because if there's a huge move, these are going to gain the most value, right? And then out the money on the put side, same thing, well below the current price. So the question is always, do I gravitate towards in the money, at the money, or out the money, right? When we're talking about strikes. When we're talking about strikes, right, we have to take into consideration the expiration first before we're looking at these, right? In terms of expiration, what we have here on a day trade perspective is that we have weekly calls or puts, usually weekly options in the options realm. These weekly options, right, what they're gonna help us do is decide where, right, will this underlying, for example, Amazon, expire within this period, right? So if I select, for example, the June 10th, and I say 123 calls, and I buy those calls, right? By June 10th, into the close of that week, I expect price to be above this level if I'm going to buy these calls, right? That is the notion that we're going forward with. So when I day trade, I don't gravitate past 2 weeks of time value, right? When we select a week further out, for example, you can see 10 days here. When we select something 10 days out, The reality of it is that your options are going to move much less, right? Losses and gains than something closer by, right? Something that expires sooner because it has more volatility associated with it, because it has less time associated with it. So if we're selecting out the money, in the money, at the money, right? As a day trader, I gravitate away from things that are in the money unless we're into the final day of trading, the 0 days to expiry, which I don't necessarily like to trade. I don't really recommend it too much because it is more of a gamble. If you're doing 0 days to expiry, they're what people call in the business a lotto trade, where you're pretty much expecting them to go to zero. So it's not something that I necessarily find an edge in. So the closer you get to that 0 day to expiry, the closer you get to in the money calls. Now, assuming that we're not doing 0 days to expiry, we're doing 1 or 2 weeks out, what I'm going to be focused on is at the money or out the money calls. At the money, right, they have a very high gamma, which means that the price changes are going to be larger and faster than something that's out the money, for example, right, because of the delta. We're going to talk about Greeks very soon. But if we drill this down and we're focusing on at the money or out the money on either calls and puts, the next part is, well, out of all of these, right, there's so many different prices. Amazon here, if you start at the money, they go from about 240 bucks a contract. You go out the money, they go all the way down to 154. Why not buy more at 154 than less at 240, right? There's a $90 difference at that point. So this is exactly what I want to drill down, exactly what I want to talk about. So in this next screen here, you guys can see that we have the triple Qs. So these triple Qs, you can see that they have 1 day to expiry, 3 day to expiry, right? They have multiple expiries in relation to individual stocks, right? ETFs usually expire 3 times a week, Monday, Wednesday, and Friday. And that means that they have more expirations, meaning that you have more to choose from. So again, I gravitate away from the 0 days to expiry and focus on things that have a little more time and a little more value. So here you can see the scale is much, much different, right? 307 is trading at $3. And then you go all the way down into the calls at the 315, they're trading for 29 cents. So some traders may think, okay, well, this thing's trading like 12 times less, right? Or so 10 times less than the ones at the money, right? Out the money is trading 10 times less. Why don't I just buy 10 times more? Well, that's where it gets a little more difficult, right? I don't want to select something that's too far out the money, and that's when we introduce the Greeks. So the Greeks are going to play a role along with volume and open interest in what options that I want to get long in, right, for day trades, whether it's calls or puts. So again, using this example in the triple Qs here, we can see that we have the delta, right? Delta is going to be the main factor that I'm going to be focused on, which is right here on the day trade perspective. Delta, and we have to understand what gamma and theta do, because the individual pricing of gamma and theta isn't necessarily going to sway me, but what we have to know about delta first. Delta is the rate of change in the options pricing based on the underlying, right? So if we have, for example, at the midpoint, it should be around 50 delta at the money. That means for every dollar move of QQQ, this option is going to move up or down $50 on the contract. Now, if we have something at 15 delta, which is this 314 right here, that means that your gain or loss is going to be $15 on the contract for $1 move in the underlying. But that also means that you're so far away that the theta and the gamma are going to fizzle out the position, meaning that you have to have much more of an exaggerated larger move for these to actually make any money. So with gamma, we have to understand that the gamma is the highest at the money. The gamma is the rate of change of delta. So with that being said, the delta is going to change faster and quicker the closer you get to at the money, right? So whether you're out the money and it's going your way, and at a certain point you're at the money, remember that delta can go from 30 to 60. And those increase your profit if it goes in your way. So that's something that we have to consider, right? Maybe we want to trade at the monies only. And then theta, we have to understand what theta does, because theta is a time decay Greek, meaning the shorter the expiry you have, the quicker time will attribute to the loss in the contract, because that means in a day, if you're choosing the 312 calls here on triple Qs, if they're at 308 by the end of the day, right, and they haven't moved, those 312s are further out of reach, right, in a shorter period of time, meaning that they're going to lose value. So focusing on delta here, my rule of thumb is around 30 to 25 delta, ideally closer to 30 when I'm looking for day trades in the options. So when I'm looking at these right here on the triple Qs, what I'm looking at is probably somewhere here, like these 311s, 312s. Now there's a big difference because the closer the expiry is to the current time, right, the larger the delta increments are going to be. At a certain point, even if you're trading 0 days to expire, you'll notice that right towards the end of that expiration, right, the delta between at the money and out the money is going to be very, very drastic. Here, it's not so drastic, but you'll see those changes when you look at the chain long enough. So if I'm focused on these ones right here, right, I'm going to take a look then at what happens on the volume side and the open interest side, right? Again, same thing on the put side, which brings us into part number 4 here. But I also do want to take a look at the 3 days to expiry here on our friend, the triple Qs, right? The 3 days to expiry, we can see that now all of a sudden, right, we have larger prices, right? That means that the delta is going to be higher. Of course, here it's kind of missing, so we're not going to use that as a great example, but you can see the price discrepancy isn't as high as it was on the 0 day. That's the main thing that I wanted to show you, right? Again, same thing with Amazon here, for example. You can see the delta is very, very closely knit. So it's a little easier to select something at that point. Now talking about volume and open interest. Why is volume and open interest important? Volume and open interest helps us discern what options are liquid versus those that aren't liquid. We want to focus on liquidity. Now, the closer you get to expiration, right, you're probably going to see more liquidity come in, meaning that these are going to have tighter spreads because they have higher open interest and a higher volume. Now, the open interest and volume, right, they're going to be thicker on whole numbers, if you will, or more round numbers. Like, for example, 123, you can see here, volume is 27,000 on Amazon, and the open interest is 5K. Then you go down one, and it drops to 122.75, and you can see that the volume is now about 5 times less at 5,000. So those are the things that you have to consider as well. So as long as the volume and open interest is fairly thick, right, like 5,000 and above, then you can kind of mix match and look at the delta and also look at the pricing, look at the spread, and those things can really help you out choose an option. So for example, in this case, right, I'm looking to select Amazon, right? And I can see that right here, the lowest that we can see is about 39 delta, right, for 3 days out, which is pretty good, to be honest, right? 39 delta, they're not that expensive at all. At 123.50, but we can honestly buy a better delta and it's not going to cost us that much more, and we can get more liquidity on it, right? So we can have something with a 27,000 volume. The spread is 3 cents instead of 2, but the open interest is higher and the delta is higher. So maybe I'm going to gravitate towards that for the call side, something like that, right? You could even look at the 122.50s, right? They have a lot of volume and they're not that much more expensive. So in this case, the price difference isn't that drastic, right? So you can afford to look at something that's like $10, $15 more expensive, right? But if we look at the triple Qs here and we're thinking about this, we're like, okay, well, 310s to 312s, those have caught my eye on the call side. So when I'm looking at this, the 310s, they cost about 148 if I'm buying them right at market with a 2-cent spread. There's a 3-cent spread on the 311s, and then they're also about 30 cents cheaper. And then even cheaper than that, another 20 cents cheaper than that is the 312s, where they're about 80 cents right out of 25 delta. Now, if I'm looking at all these, the 310s, they stick out because they have 51,000 volume that has been traded, contracts that have been traded, and then about 4.5 open interest. So the open interest would tell us how many contracts are currently in circulation, and the volume actually tells us how many times they've been traded back and forth, right? So the open interest should be lesser than the volume. That really ensures that there's really thick liquidity. So in this sense, right, I can even afford to trade the 310s because, again, 37 delta, that's better than 30 delta. I want to have juicy fat delta without paying a lot for these options. There's a good spread. The liquidity is really fat, right? Same thing to the put side. If we go to the puts, you can see 303s, 304s, 305s, and 306s all are out the money. And volume on the 305s is the thickest, right? The open interest is pretty good. It's at 32 delta, 1 cent spread. That is the option that I'm going to lean on, depending on where I'm getting long or short, right? A lot of traders do trade at the money, calls and puts, which is, again, great. You're going to be paying more of a premium for that. But at the same time, what you're going to be doing is making sure that the delta is very thick, so it corresponds fairly well to the movement in the underlying. The last thing you want to do if the triple Qs are trading at 308 and you're looking for the downside is buy a 299 put that expires in a day, right? Realistically, that's not going to gain any real value unless there's a massive aggressive drop throughout that day. So again, to review this, what we talked about strikes. What's the importance of strikes, right? The expirations with those strikes, what to choose as a day trader. So I don't go past usually 2 weeks out. So the current week that we're sitting in, that Friday expiration is the one that I gravitate towards as a day trader. Sometimes you can afford to go even a bit further out. ETFs have 3 expiries, Monday, Wednesday, Friday. So you can choose from those 3 as the week goes on, right? We also talked about the out the money, at the money, in the money, which ones we want to focus on as day traders and going into Greeks from that, right? Focusing on around a 30 delta as a choice for out the money, right? We don't want to go too much further than that. And that's based on the liquidity. How tight's the spread? How thick is the volume in comparison to its counterparts? Open interest as well. And we jotted down some examples, which options we would select based on those criteria. So I hope you learn a lot about day trading options, which options to select, and now comes the hard part, actually trading them. So if you want to learn more about that, let me know, drop a comment down below, and let me know, did this help you revise how you select options, right, as a day trader? If you want to know more about swing trades, let me know, drop comments down below. What else would you like to see? So I hope you guys enjoyed this video. Smash that like button, hit that subscribe button, and we'll see you guys next time.